Hello and welcome back to Infinite Banking Step by Step. This is the third video in this series. If you missed parts 1 and 2, please go back and start at the beginning. In video 2, we covered the major problem faced by virtually every household. That is the volume of interest they pay on a monthly basis, not the rate of interest that they pay. All of those dollars being used to pay interest payments are gone forever and out of their control. So in this video, given that this is a huge problem, what do you do about it? Let's talk about the typical American recommendations for how to solve this problem. Well, in the United States, we're really told to ignore this problem. That's just how things are done. We're told to look ahead to the future and save for retirement in tax-qualified retirement accounts, generally speaking. These might be 401ks, IRAs, SEP IRAs, 403bs, 457 plans, etc., etc. There are a lot of variations. Now, these types of plans, as they're called, are not saving at all. They are investment vehicles, not savings vehicles, and that will be an important distinction as we continue our exploration of infinite banking. But for now, let's just say that this advice is insufficient. Why? Well, first of all, let me give you another great quote from Nelson Nash, the author of Becoming Your Own Banker and the person who named the infinite banking concept. When government creates a problem, onerous taxation, and then turns around and gives you a solution to the problem they created, any tax-qualified plan, aren't you just a little bit suspicious that you're being manipulated? That's one of my favorite quotes from Nelson. So regardless of which one of those vehicles you're using or what combination of vehicles you're using, the basic idea is that, well, you just deal with it. That's just how things are. And so to fight this problem in the future, you're going to set aside a portion of your income and hope that through the magic of the stock market, you're going to accumulate a large pile of money to use in the future, so you don't have to work for your entire life. We hope that this will outpace inflation, and then it will be a nice, big, healthy nest egg to live on in retirement. Now, if you've correctly understood the problem, you'll see that this is a deflection. That is not a solution to the problem at all. Now, in Becoming Your Own Banker, Nelson Nash estimates that about 34.5%, what I'm just going to say is 35%, of the average American household spending is going to interest payments. This is things like the mortgage that we looked at in the last video, but it's also car payments, credit cards, etc., etc. There's a lot of financing going on in the average American household. So if you are setting aside 4% of your paycheck or 6% of your paycheck or maybe even 10% of your paycheck to save for retirement, and you're going to do that in such a way and manage your money so well that it's going to outpace inflation and do all of these wonderful things and give you this huge balloon of money that you can then access later in life, that's all well and good, but do you think maybe we should focus on a third of your income going to interest payments now? If you're 25 years old, you might be working for 40 or more years before retirement. What about the cash flow that you need access to in those 40 years? You can immediately see that this doesn't make any sense, right? You're already taking this massive haircut on your paycheck, and this is even after taxes, by the way. So you take a haircut from taxes, you take a haircut from interest payments, then you give yourself a haircut from saving for retirement, and we're supposed to just be happy with what's left. Okay, let's go through an example. Let's say your income is $150,000. You decide to set aside 10% of that income, or $15,000, into a pre-tax account. Let's say it's a 401k. If you're married and you don't have a state income tax, and then after your federal income tax and your FICA taxes, you'll have a little over $109,000. It's $109,304 of remaining net income. So then if 35% of that is going to make interest payments, what are you left with? Well, $71,395. Remember that on paper you make $150,000. So even before you've spent money on anything, you've already given up more than half of your on-paper income. And of course, that only stays with you until you spend it. Once you go buy the things that you need to live, that money's gone forever too. So at this point, I have two questions for you. Number one, do you think that saving 10% of your income in a tax-qualified retirement account to grow in the stock market is sufficient compensation for routinely handing out 35% of your income to finance companies and banks? And question number two, which one has a bigger impact on your life today, next week, and in the next few years? The 10% that you are saving for retirement, or the 35% that you are giving out to other companies just for the convenience of having access to money today? Note that I'm not telling you to stop funding your tax-qualified retirement accounts. What I am telling you is to think about which one is more important to your well-being. Some people I've worked with have definitely decided, after reviewing all the facts, to stop funding their tax-qualified plans. But that's not the purpose of this series. The purpose is to get you thinking about these things. So we've reviewed the standard American household, the conventional wisdom way of trying to deal with the fact that you're giving away so much of your money. I don't believe that it's an adequate solution. So let's look at a counterpoint. What about the infinite banking way of dealing with this? That's what we'll cover in the next video. You should see a link to it appearing on this screen very soon. Thank you so much for watching, and I'll see you in the next one.